You are not going to believe what BlackRock CEO and chairman Larry Fink just outlined in his annual chairman's letter. Not only does he outline kind of where markets are shifting towards and the way that kind of asset managers are going to be shifting the way that they're going to be allocating capital moving forward in the future, but he also outlines democratization of investing. He also talks about Swift and how Bitcoin could actually be a threat to the US dollar in the near future here. We have a lot of information to cover in this video this evening, guys. Again, if you do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you hit that subscribe button and turn on notifications so you're notified every time these videos do go live. And again, if you want even more insight into markets every single week and get access to all of the single stock analysis that I do for my members, all of the macro research reports, all of the weekly market analysis in the group calls that we do, going through all of your questions as it relates to markets, make sure you guys check out that link down below. Join VIX Insights. It literally only costs you $10 a month. But let's get right into the video over here. First things first, we're going to be covering a little bit of the way that Larry Fink has seen and is starting to see markets shifting in the near future. So economies run on capital. Whether you're assembling a 17th century trading fleets or 21st century data centers, the money has to come from somewhere, but historically it hasn't been investors. Despite 400 years of financial innovation, from Amsterdam to Change Alley to the New York Stock Exchange, most financing has come from banks, corporations, and governments, not the capital markets. Well, why banks, corporations, and governments? Well, because that's where people put their money historically. They parked their savings in bank accounts, drove corporate growth through consumption, and paid taxes that fund public spending. But when my partners and I founded BlackRock in 1988, we believed the world was changing. These capital markets wouldn't just supplement banks, corporations, and governments. They'd stand alongside them as a co-equal source of capital. The logic was simple. Markets delivered better returns than the other three. Better returns would attract more investors would deepen markets, and deeper markets meant more capital. Plus, asset managers could accelerate this shift through innovation. For BlackRock, that meant first developing better technology to manage risk, then expanding choice and lowering fees through products like exchange-traded funds. So a lot of this capital that is being raised to drive innovation, again, is now coming from these capital markets here. But Larry Fink and BlackRock see a very, very interesting shift happening in the near future, and that's getting the public market, the public investors involved in the private markets here. Most of us associate markets with public markets, stocks, bonds, and commodities. But if you generally cannot buy shares in a new high-speed rail line or a next-generation power grid system on the London or New York Stock Exchange. Instead, infrastructure projects are typically investable only through private markets. Private markets are, as their name suggests, private. For individual investors, they often require higher minimums, and even when the minimums are lower, investing is often limited to people with certain income or net worth. They're talking about the term accredited investors, basically. The same hurdles apply to most of the world's companies. Only a tiny fraction are publicly traded, and that fraction is shrinking. The path BlackRock took 25 years ago, raising money through an IPO, is becoming rare. Instead, 81% of US companies with over $100 million in revenue are privately held. This percentage is higher in the EU and even higher in the UK. Yet, these companies still need money to innovate and grow. For decades, they turned to banks, much like families turn to lenders for their home mortgages, but that era is rapidly fading. Today, banks by themselves cannot meet the capital demands of growing companies. So what Larry Fink is effectively saying here is that there are so many of these privately held companies around the world that are unbelievable companies that just need a little bit more capital in order to continue driving innovation, to continue to increase the quality of life of everybody around the world through a lot of this innovation here. But right now, it's very difficult for a lot of these privately held companies to gain capital in the typical routes that they would have gone through in the past. And that is why when we move down here a little bit, again, Larry Fink does think that in the future, we are going to see this shift here. Again, if you're familiar with modern portfolio theory, 60% allocation to stocks, 40% allocation to bonds. There's been much debate about this kind of portfolio structure over the years. And Larry Fink does see this structure shifting to more 50, 30, 20 here. And what BlackRock is also doing in order to kind of drive this type of growth in the private space. In October, BlackRock completed the first of 3 acquisitions, global infrastructure partners, to erase the boundary holding investment back. GIP owns some of the world's most important infrastructure assets on behalf of our clients: London's Gatwick Airport, key energy pipelines, and over 40 global data centers. They're experts at finding the world's most attractive infrastructure investments and channeling capital to build or improve them. GIP, put another way, is itself a pipeline connecting BlackRock clients directly to the world's $68 trillion infrastructure boom, including data centers. So it's very interesting to hear Larry Fink and BlackRock talk about private markets in this way, because when you talk to a lot of other individuals out there as well, there is a significant amount of demand for getting into some of these investments in the private sector there. And if BlackRock can help more money get funneled into these types of investments, well, you could see a lot more innovative growth that can, again, as I said before, really increase the quality of people's lives down the road. Now, I want to talk a little bit about some of its comments here, kind of on these deficits, Bitcoin, the crypto space, de-dollarization, and tokenization. That's a lot to throw at you right there. But can Bitcoin eat away at the US dollar's reserve status? The US has benefited from the dollar serving as the world's reserve currency for decades, but that's not guaranteed to last forever. The national debt has grown at 3 times the pace of GDP since Times Square's debt clock started ticking in 1989. This year, interest payments will pass $952 billion, exceeding defense spending. By 2030, mandatory government spending and debt service will consume all of federal revenue, creating a permanent deficit. If the US doesn't get its debt under control, if deficits keep ballooning, America risks losing that position to digital assets like Bitcoin. Now, there's a couple of things that we have seen over the past kind of year and a half here that has started to kind of lean in this way. Again, you have seen interest rates. Again, the Federal Reserve has come out and increased interest rates here, and that definitely has caused U.S. Treasury yields to go up as well. But if you continue to see the US get into more and more debt, well, again, more debt is typically always going to come with more risk, and people are not going to want to put money in any type of US assets or US fixed income, which increases interest rates, which again is going to make the quality of life, again, in America a lot lower. It's going to be a lot harder for businesses to grow. You're not going to be able to own a home. You're not going to be able to go out and get the car loan that you want. Again, being able to have a lot of this demand for US assets, it is what enables a lot of this capital to flow around in the economy. And this is where things start to get very interesting in this letter from Larry Fink here. Tokenization is democratization. The world's money moves through plumbing built when trading floors still shouted orders and fax machines felt revolutionary. Take the Society for Worldwide Interbank Financial Telecommunications, SWIFT. It's the system that underpins trillions of dollars in global transactions every day, and it works much like a relay race. Banks hand off instructions one by one, meticulously checking details at each step. That relay approach made sense in the 1970s, an analog era when the markets were much smaller and daily transactions were much fewer. But today, relying on SWIFT feels like routing emails through the post office. So if Larry Fink is seeing the writing on the wall here that SWIFT is a completely outdated way and system to be doing these cross-border transactions here, is it possible that in the future they're going to be more supportive of something like XRP? Yes, but it's also possible that they kind of go the route of those dollar-backed stablecoins, which again are something that is being floated around at this current time. Now, tokenization changes all that. If SWIFT is the postal service, tokenization is email itself. Assets move directly and instantly, sidestepping intermediaries. What exactly is tokenization? It's turning real-world assets, stocks, bonds, real estate into digital tokens tradable online. Each token certifies your ownership of a specific asset, much like a digital deed. Unlike traditional paper certificates, these tokens live securely on a blockchain, enabling instant buying, selling, and transferring without cumbersome paperwork or waiting periods. And again, one of the main reasons why Larry Fink is going to be in support of this, remember, we've been talking a little bit about in this video here, Larry Fink's comments about democratization and giving more people more access to a lot of these different capital markets here. It can democratize access. Tokenization allows for fractional ownership. That means assets could be sliced into infinitely small pieces. This lowers one of the barriers to investing in valuable, previously inaccessible assets like private real estate and private equity. It can democratize shareholder voting. When you own a stock, you have the right to vote on the company's shareholder proposals. Honestly, something that Blackrock has kind of come under fire for in the past due to the fact that they are the custodian of a lot of these shares of stock within a lot of their ETFs that they have. Tokenization makes that easier because your ownership and voting rights are digitally tracked, allowing you to vote seamlessly and securely from anywhere. It can democratize yield. Some investments produce much higher returns than others, but only big investors can get into them. One reason? Friction. Legal, operational, bureaucratic. Tokenization strips that away, allowing more people more access to potentially higher returns. So there's a lot of really interesting insights in here, guys, in this chairman's letter from the CEO and chairman of Blackrock, Larry Fink. We're talking about the democratization of finance as a whole, giving more access to more people to these markets, and a lot of people benefit from that. You have the private companies that are able to generate more capital that can then go out and drive more innovation and try and increase the quality of everybody's lives by really kind of following through on their goals that they've had for their business. Then we have tokenization of assets as a whole. We have, again, kind of innovating past a lot of these old outdated systems that have been in use for a while. Swift, again, for those of you guys that are holding XRP, they could definitely get a piece of that moving forward. Again, some of it's probably going to go to those dollar or currency backed stable coins there in order to make these transactions more seamless, more cost effective for everybody involved. So guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis I provided for you guys in this one, make sure you guys go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed and turn on notifications so you're notified every time these videos go live. So I'll see you guys in the next one. Hope you guys have a great rest of your evening. Peace.